we are going to look at a very interesting and technical topic for advanced taxation. Interesting and technical, and that is because it plays a very important role in the economy of this country. Okay, I'm talking about petroleum profit tax. Petroleum profit tax. We all know that a large chunk of the Nigerian revenue is gotten from oil and gas, and so because of that, the authority, the government, decided to give that sector priority up to the extent of the tax generated from that sector. And so even at the exam level, the examiner paid so much attention, attached so much importance to that topic, that the topic alone is carrying 1/3 of the whole syllabus. 1/3 of the whole syllabus, almost 1/3 of the whole syllabus. The weight there is about 30%. And so we are going to dwell on petroleum profit tax extensively. Okay. It's always an interesting area for examiner. You are expected to attempt question in this area. So we are going to go about it this way. Petroleum profit tax. Let's try to take do an overview of the industry itself, the petroleum industry. Right? Oil was discovered in Nigeria in the 50s. And after the discovery of oil, we all know what the agricultural sector is like now. Then came up the issue of joint venture between the Nigerian federal government through the NNPC. Okay, the joint venture has it that the federal government owns 59%, Shell, British Petroleum, BP, owns 30%, and other oil producers own 15%. Joint venture was entered into to allow the extraction and exploration of oil. Alright, extraction and exploration of oil. So that is that. Now the industry itself is divided into two, is classified into two. The petroleum industry is classified into two. We have the upstream sector and the downstream sector. What are these sectors all about? What are the activities of these sectors? I will briefly take you through what is done in the upstream sector and what is done in the downstream sector. The upstream sector, this involves all the activities carried out in the exploration, development and production of crude oil from its natural state. Are you there? I'll take that again. It involves the activities carried on in exploration, in development and production of crude oil from its natural state. Exploration, that's discovery, trying to bring out the crude oil in its natural state from the ground. Okay, that is upstream sector. This is the sector that is usually referred to as petroleum operation. All right, this is the sector we refer to as petroleum operation. This is the real sector. All right, petroleum operation, PO. Okay, that is the upstream sector. Are you there? And there are companies that are engaged in these activities. These companies are called E&P companies. E&P, Exploration and Production Company. Exploration and production company. Example is the Shell, BP, Mobil, ExxonMobil. Okay, exploration and production. That is E and P companies. Are we together? So that is it. The income of these companies are subjected to tax under the Petroleum Profit Tax Act. Petroleum Profit Tax Act as amended 1990. Now, what is the distinguishing feature between the upstream sector and the downstream sector? I'm going to tell you what the downstream sector is also about too, but let's look at the distinguishing feature. One, the upstream sector is capital intensive operation. Drilling the oil drilling oil well need, what do you call it, very capital intensive instruments, machines, okay, rigs that does the drilling. High business risk. It's a high business risk area. High business risk area. Do you get that? With the trouble in the Niger Delta, oil pipe are being destroyed, damaged. All this are posing risk to the companies in that business. All right. So it also have a complex tax reporting system. Okay. Now let's look at the downstream sector too. You see, all operations involved in the conversion of crude oil produced into usable form, e.g. your petrol, PMS, premium motor spirit, kerosene, AGO, automotive gas oil, are referred to as downstream operation. So the marketers, oil marketers, your Wando and what have you, Mobil, they are all in the downstream sector. So basically they are into marketing. Okay, marketing. It also includes activities such as pipelines and storage, petrochemical sales and services. Right, these are downstream sector. We are referred to as downstream sector. Let's quickly go through them. What are the activities that we usually find in the upstream sector? Right, the activity includes one, mineral right acquisition. This is at the point where the oil company acquires the right to mineral, to explore the mineral, exploration and production of the mineral in the ground. Now this mineral right acquisition are in form of licenses. All right, these companies are issued licenses. For licenses, we have three forms of licenses. We have the oil exploration license, OML. Okay, let me try and put something here. OML license. That's one. Licenses, type of licenses. OML, oil exploration license. OEL, oil exploration license. I need to correct this. This should be E. Okay, OEL, oil exploration license. The other one is oil prospecting license. The first one grants them the right to explore, while the second one, oil prospecting license, OPL, gives the right to prospect. And then the last one, oil mining license, OML. So these are the three licenses. The second activity, that was the mineral right acquisition activity. The second activity in the upstream sector is the exploration and drilling. Right, the exploration and drilling. This involves identifying the area that may warrant evaluation and evaluating those areas considered to have petroleum prospect. That's exploration and drilling. At this point now, you have identified the area that will need that will be considered, that you think there's petroleum prospect there. All right. And what have you for the third one? Let's see. The third one is the production. Development. Sorry. The third is development. Maybe I should quickly put them down here so that you pick them on. So upstream activities. Right. One is mining right acquisition. Mineral right acquisition. All right. Two, exploration and drilling. Three, development. Okay. And four, production. So these are the activities, the upstream sector. Okay. For development, this one it involves the development of oil wells after hydrocarbon have been found in commercial quantity. All right. This is the point where banks come in. They usually assist with funds at the development stage, because there is a light at the end of the tunnel that oil, it's there. Right. And then the production, this involves the lifting or conveying the oil and gas to the surface, bringing up to the surface now, gathering, treating, feed processing, and storage. So enough of that. Let's just move on. Another part of the industry is the gas exploration. So remember, we're talking about oil and gas. This should be exploration, not exploitation. Exploration, gas exploration. What have we got to say about gas exploration? For gas exploration, we are looking at this separation of gas from reservoir into usable form. Separating the gas from reservoir into usable form at utilization through pipeline or tanker. All right. So we all know what gas is. The gas we use, the domestic gas, it's a byproduct of petroleum, crude oil. All right. Now, that is another sector. They are also beneficiary of some incentives by the federal government. What are the incentives that are available to the companies in the gas sector of that industry? Okay, so the incentives that are available to companies in the gas industry, or the gas industry itself, it depends on the activities involved. We have the gas exploitation, we have the gas utilization. Are you there? And then we have the gas development project. All right, that will determine the incentive that is granted at each of this level. For the gas exploitation, what are the incentives? Let's go through the incentives that are available to them. One, okay, in the course of separating oil and gas from the reservoir into usable product, it is considered part of the oil field development. The cost of doing that is regarded as part of the oil field development. They are regarded as qualifying capital expenditure, and so will be claiming capital allowance. Okay, that's one incentive. Two, capital investment facilities to deliver associated gas in usable form at utilization or designated custody transfer point will be treated for fiscal purpose as part of capital investment for oil development. Did you get that? So that's another incentive. We are looking at incentives available here. Okay, incentives available. This is where we are. Incentives available to the gas industry. Okay, So if it comes to gas utilization, what are the incentives we'll be looking at? For gas utilization, the second aspect of the gas industry, which involves the marketing and distribution of gas for domestic and industrial use, such as power generation. All right, the incentives that are available to this side of it is that the company is subjected to tax under CETA. The company is subjected to tax under CETA. The initial tax holiday for 3 years, renewable for an additional 2 years. There's initial tax holiday for 2 years, and this is renewable for additional 2 years. The tax relief period is to commence on the production day of the company. All right. There's also what we call accelerated capital allowance after tax holiday. Okay, they are available at these rates. Investment in plant and industry, 90% annual allowance with 1% retention. Okay, these are the incentives. So I think we should move away from here and go on. Let's quickly look at the quality of Nigerian crude oil. Just have them here. Quality of Nigerian crude oil. These are technical terms. It varies from between light crude of 450 API. API here stands for American Petroleum Institute. That's the measurement. That's how the oil is being measured. American Petroleum Institute. That's the scale for measurement in the whole world. And the heavy crude oil of 210 API, American Petroleum Institute, and weight average of 320 API. All these are measurement, the rates, are the way you measure the quality of crude oil. Okay, what are the laws and agreement governing the petroleum profit tax? We want to look at those for now. For that, we have Petroleum Profit Tax Act of 1959. That's one of the law that's governing or guiding or regulating the petroleum profit tax. Association Gas Fiscal Arrangements of 1992. Production Sharing Contract 1993. Production Sharing Contract, I want to say something here. I think I should say one or two things. I should say one or two things here. Okay, here we are looking at production sharing contract, and you remember we're talking about the law and agreement. This is one of the agreements. This is one of the agreement that we want to look at. Under this agreement, NNPC enters into a contact with a foreign company. Are you there? That's how it works. The NNPC will come into contact with a foreign company. That foreign company is regarded as the contractor. Did you get that? This contractor will engage in oil exploration and production, right? With the understanding, there's always an understanding here, that it has no title to the oil deposit. So it's not the owner of the oil deposit. That will be made clear in the agreement. All right? And that the continuation of the contract will depend on the discovery of oil in its commercial quantity. The contractor will bear all the risks. The contractor bears all the risk. Did you get that? Now, if oil is found in a commercial quantity, the contractor will recoup its investment and cost of operation after deducting royalty and things like tax. The profit is shared on a pro rata basis. All right? The contractor is allowed to market, all right, the portion of the production allocated to cost oil and its share of profit oil bought at the price fixed by the NNPC. Are you there? So the contractor is allowed to market, but it is at a price fixed by the NNPC. So that is what we need to know about production sharing contract. I think we have discussed extensively there. It is one of the agreements. We'll look at other agreements. Which was not typed here. I want us to look at risk service contract. Risk service contract. Risk, right? Service contract. Risk service contract. And that is RSC. RSC. Okay. For this service contract, we are looking at a situation that is called operation or work contract, right? This contract usually has a duration. It does not exceed 5 years, okay, and it relates to a single block, oil field. We talk blocks in the oil field now. Just like the production sharing contract, the NNPC does not have title to the oil deposit, okay, and the company carries on exploration, development, and production activity on behalf of the NNPC, at its own risk. So it therefore provides the risk capital and technical expertise. Okay. Here it is the NNPC that has the right to market the oil produced. The NNPC has the right to market the oil produced. Are you there? And how is the contractor paid? How is it remunerated? He is reimbursed only from funds derived from the sale of oil produced. Did you get that? So again, that is risk service contract. So these are agreements we need to know about the oil industry: the production sharing contract and the risk service contract.